Picture this, you're inflating a balloon. At first it's going fine. You're adding air, it expands, but at some point you start to wonder, how much more air can this thing take before it pops? That's exactly what's happening with the stock market right now. The Buffett indicator just hit an all-time high, over 200%. Historically, that means bad things tend to follow. Think stock market drops and recessions. So today we're going to do three things. One, we're going to talk about what the Buffett indicator actually is without all of the confusing jargon. Two, why this sky-high reading is a big red warning sign. And three, we'll talk about how you can use this information to protect your retirement savings before the market takes a hit. Well, to start with, you know, no doubt who Warren Buffett is. He's the most famous investor of all time. He's known for being perhaps the greatest value investor who ever lived. Buffett designed this indicator as a simple gauge to see if stocks are overpriced or if there's still room to grow. He's on record for calling this the best single measure of stock market valuation. So this is something we need to be paying attention to. In complex terms, it takes the total market capitalization of the stock market divided by the GDP of the country and then multiplies it by 100. In non-complex terms, in real life terms, it shows the value of the market compared to the size of the economy. You see, the market and the economy tend to move in a similar direction, but they don't always do it in lockstep. In this case, a high Buffett indicator means that the market has grown way faster than the economy has. Think about it like this. Picture that balloon that I was talking about. The air inside the balloon represents the stock market, and the balloon itself represents the economy. If you keep pumping air in at a steady rate, the balloon expands in a healthy way, just the way that it's supposed to, just like a market that grows in line with economic fundamentals. But what happens when you keep inflating it past its limit? It pops. That's what the Buffett indicator is trying to measure. It looks at how much air, stock market value, has been pumped into the economy. And right now, we're looking at the biggest, most overinflated balloon in history. That's not hyperbole. I'm going to show you in a second. It's literally as high as it's ever been. And so here's how the actual math breaks out. Historically, if we're looking at a ratio of 70 to 80%, that's normal. Anything below that would tell us that the market's actually cheap, which could mean a good time to buy. If the indicator gets to 100%, it's a sign that the market is considered expensive. Anything way over 100%, flashing red lights start. Right now, it's over 200%, meaning the stock market growth has way outpaced the actual economy. That's kind of like trying to fit an elephant into a doghouse. It's just not going to work very well. And so why should we care? Well, let's take a look at what's happened in the past when the balloon has gotten too big. This isn't just some theoretical number. Every time the Buffett indicator has reached extreme levels, the market has paid the price. So I'm going to show you a chart. We're going to rewind some history here. First off, if we look at the dot-com bubble, this started in early 2000 after the run-up in the 90s. The Buffett indicator hit 146% before the dot-com bubble burst. What followed was the NASDAQ crashing over 75%, wiping out trillions of dollars in wealth. The second time we want to pay attention to it. Look at the 2008 financial crisis. The indicator climbed up over 100% to about 110% before the Great Recession. The stock market plunged by over 50%. Retirement accounts were crushed. And then you look at 2021, the third time recently, the Buffett indicator hit 189% at that point, higher than ever before. That was right before 2022. Remember 2022? The market was down pretty much for a year in a row. It was down about 25%. And now you can see that we're actually higher than that. We're up over 200%. I'm sure you can figure out at this point why this is not good news. Now, that doesn't mean that a crash is about to happen, but it does mean that stocks are overvalued relative to what's going on in the economy. And that means one of two things. Either stock prices are going to come down to put those two numbers back in line, or the economy is going to have to grow really well, really fast, while the market kind of stays flat or grows at a slower pace for those two things to come together. One of the two's got to happen. We can't go on this path indefinitely. And so now we know that this is not a good thing. Let's talk about what you can do to protect your retirement savings if there is a big market downturn. So number one, diversify beyond just stocks. If your portfolio is seriously stock heavy, especially if you're in your mid-50s or older, you're riding the roller coaster with no seatbelt, you've got to diversify. The first thing I normally hear these days when I say that to somebody is, yeah, but look at how much money I've made by having those stocks. And that's true. That's also exactly the reason why you need to diversify. Have you ever heard the saying, what goes up must come down? The statistical concept here is what's known as reversion to the mean. The non-jargon term is you gotta sell and take some of these chips off the table and stop risking your financial future on a bet that the market won't ever go down. Now, we do this for our clients by using a 3-bucket strategy to help them diversify from this sort of risk. I'm not gonna get into that here because I've done that a few times in videos lately. Check out the channel. You'll see some videos about that sort of thing, and you can see how we would suggest diversifying. The second thing you can do, keep a cash cushion. Let's go back to Warren Buffett. He's sitting on the largest amount of cash he's had in over 30 years right now. Last I checked, he's sitting on more than $325 billion in cash at Berkshire Hathaway. Now, Buffett isn't just sitting on cash for fun. He's waiting for the market to drop so he can turn around and buy things cheaply. If he's playing defense, shouldn't you consider it too? Now, I doubt anybody watching this video is capable of sitting on $325 billion, but holding a little extra cash right now can do two things. It can buffer against potential losses from your portfolio, and it can also provide capital to buy additional assets if there is a pullback at the new lower prices. When the market crashes, the worst thing you can do is sell at the bottom. The second worst thing you can do is not have any money around to buy the assets that are on sale. Another all-time great Buffett quote, "Be fearful when others are greedy and be greedy when others are fearful." Right now, Buffett's cash hoard shows us that he's investing fearfully. He's being fearful. He's buffering against a big downturn. And you can be sure that if and when that happens, he'll put that cash to use by being greedy while others are running for the hills. A third step you can take, rebalance your portfolio. This is something that's typically table stakes if you're working with a professional advisor. They should be doing this sort of thing at least annually. But what I find lots of the time is for investors who do it on their own, they never rebalance. And what happens then is that your winners grow larger and larger, and they tend to take over the portfolio, which indirectly increases the risk you have in your portfolio. Think of it like planting a garden. If you planted things just how you wanted them, little of this here, little of that there, but then one plant was growing extremely fast and you never pruned it back, eventually it would just grow and take over the whole garden and it would look terrible. Rebalance your portfolio, trim back the big gainers, and move those assets to the lower performing asset classes. This sounds counterproductive, but it's something that everyone should be doing. You've got to tend to the garden. The next tip, make sure that you're actually diversified according to your own time frame for using the money and your own risk level. Lots of people confuse good returns with good investing. Think about the old saying, a rising tide lifts all boats. It's easy to think that things must be set up correctly if your account balances are growing. Those are two different ideas. Accounts have grown because the market's gone up so much. That doesn't mean that you're properly invested or properly diversified, that you have a portfolio that represents all of the asset classes you should have, not just lots of growth stocks. The time to fix that is before a major downturn, which leads me to my final point. Have a retirement plan that works in all markets. If your retirement strategy only works when stocks are booming, it's not actually a plan. A well-structured retirement plan should factor in both bull and bear markets. It should include a plan for your investments, a plan for your income, for your taxes, for your healthcare costs, and for what happens to the money after you're gone. You need a plan that addresses all 5 of those areas. And look, if you're unsure of where you stand, this is exactly what I help my clients do. Click the first link in the description, set up a time to talk, and while you're down there, check out the other links I put down there. I've got links to a couple of our best guides for you as well. The Buffett indicator is screaming that the market is in dangerous territory. Now, this doesn't mean you need to panic. It doesn't mean that a crash is imminent, but it does mean that you need a plan. So, what's your plan? If the market drops, will you be prepared or will you be caught scrambling? If you're not sure, check out this video next.